In today's show, Ken Race and I are going to be discussing inheritance strategies that help make your children richer. Now, whether you've already built a substantial wealth through your property portfolio or you're just starting on your financial journey, it's never too early or too late to start thinking about how you could pass on your wealth to the next generation. Today, Ken and I are going to share his insights and expertise on topics such as estate planning, trust structures, and tax implications of inheritance. We're going to discuss the pros and cons of different strategies, including gifting, testamentary trust, family trusts, and we're going to explore how these can be tailored to your specific needs and circumstances. So whether you're a parent looking to provide for your child's future, your children's future, or just curious about inheritance strategies and how they work, this episode's for you. So join us as we dive into the world of wealth creation and inheritance planning with Ken Race.
Welcome to the Michael Yardney podcast, where twice each week you will learn a number of new ideas regarding success, property investment, and money in around 30 minutes. Our show is brought to you by Metropole, who specialise in helping you grow, protect, and pass on your wealth through strategic property and wealth advice. Now, here's your host, Michael Yardney, Australia's authority in wealth creation through property, who has been voted one of Australia's top 50 most influential thought leaders.
Inheritance planning is becoming more complex as people are living longer and family structures become, more intricate. So according to my guest today, Ken Race, Australia's leading property, tax and structuring advisor and director of Metropole Wealth Advisory, with baby boomers estimated to bequeath somewhere between $3.5 and $4.9 trillion in cash and other assets to future generations, I think it's really important to consider a range of inheritance strategies. Now, Ken's worked with countless clients to help them create wealth and build a legacy for their families. So as a baby boomer with a blended family, I'm looking forward to hearing Ken's thoughts. Hello, Ken.
Hi, Michael. Hi, audience.
Well, as longer life expectancy means that people are more likely to give bequests during their lifetime now, I think, and also with intergenerational wealth transfers increasing early, a way that people are looking to help their families pay off debt or to meet the needs of their beneficiaries earlier in life, it seems like it's going to be important for us to plan, maybe to start giving with a warm hand rather than a cold hand when we've passed on. So maybe I'd like to discuss some of the important considerations planning our inheritance strategies for our children and maybe some of the tax consequences. So what sort of things do you advise the clients at Metropole Wealth Advisory about in this regard?
Look, maybe to start off with, it's funny how the world has changed. I remember 20 years ago when I was doing presentations talking about the ski generation.
Yeah, what was that?
Spend the kids' inheritance.
Yes, I remember.
And leave nothing for the kids, leave nothing for the grandkids. I'm going to enjoy life. And they've worked hard, you've worked hard, and why not? But the circle's slowly coming back to, no, I've created enough wealth for myself. I can't spend it all, or I don't want to spend it all, and I want to leave it to my kids, particularly in an environment that we're in at the moment with cost of living pressures, building up the savings to buy a property is getting harder and harder. So parents come back to, what they're always doing, looking after their kids. So
that never changes, Ken.
It never changes.
And we both know having older kids and adult kids and families, that's right. But that's okay. My parents looked after me when I had troubles in my life too.
Yeah. So we're getting more and more clients coming to us about how can they build a robust estate plan, which includes a will, so that they can do two things. They can distribute to family members and do it in a way that achieves their wishes, their desires. So they don't want to rule from the grave. They want to guide by the grave, because we're seeing statistics now that over 50% of wills are contested. And out of those, 70% are won by the person contesting it. It's more and more important, I think, to come up with a robust will as opposed to the simple DIY or the local lawyer who doesn't have a specialty in this, to get proper advice, particularly if you've got property, you've got share portfolios, our children travel more, there's different tax implications. So traditionally, inherited assets come without taxes. But in some cases, they are taxed. So it's important to know when those triggers occur and build accordingly.
Also, Ken, there's more blended families, aren't there? So that actually brings in another layer of complexity.
Absolutely correct. So what I normally see with the blended families is, pre the second or third marriage, those assets I really want to safeguard for my original children, and stuff from now on for the new family that could be created. But if it's an older couple, it's how does it go back to the original family, as opposed to it could go to somebody that's really unbeknown to you.
Okay, so let's talk about a couple of strategies you've got to think about when you're planning.
I think you've got to start off talking to your family members. That is critical. You've got to let them know what you're thinking. And that's for two reasons. Because if you're going to leave somebody out or not distribute as much because you might say, I gave you a gift to help you buy your first home and therefore I'll reduce your inheritance later on, you've really got to lay out your reasoning for leaving somebody out or making a non-even. Because if it gets contested, a judge will decide. And in the absence of knowing why you made certain decisions, they will take the moral high ground and say, well, why didn't you? You should have. So the other reason is to get the children involved, particularly if you've got a substantial family wealth, so that they start to understand how you built it up, why you built it up, the different components of it, so they take over the management of that correctly. So we often hear that the second generation might build it up and inherit. The third generation loses it all. They've got no respect for it. So I think bringing that family into that decision of how you're doing it and why you're doing it is important. And you do that before you go and see the lawyer. So prepare your map, if you like, of where money's going to go to, how, why. And an old lawyer, well, he wasn't old, it was a lawyer a long time ago, said this particular story, kill the relatives. And, the whole audience ears pricked up. So obviously he didn't mean that literally. But it's think of what happens when the person you're bequeathing an inheritance to, when they pass away. Where's it going to go? Now, that's what I was talking about earlier. You don't want to rule from the grave. You want to guide from the grave. But if it's someone that you would rather not be part of that inheritance, you've actually got to identify that up front as quickly as possible. So those sorts of things will, I think, reduce the number of challenges. Well, maybe not reduce. It'll certainly reduce the number of successful challenges. And it's important to note that not anybody can challenge. You've got to be within a prescribed group of people, spouses, children, etc., etc. So your friend that you have the occasional beer with down the pub can't challenge. Why didn't I not get anything?
Sure. But I was fascinated when you mentioned a short while ago the number of challenges that are successful. And we did have a chat a while ago personally about something that was written up in the Financial Review of somebody who actually even attempted to murder their father. But when the father died, not because of anything they did, they contested it because they were left out of the will, and the judge gave them millions of dollars. So that's interesting. Now, what about setting up structures in advance, the right sort of structures for moving down later on?
So maybe to premise that, there's potentially different tax implications on money going to the next generation. So just to give you an example, superannuation, going to a non-spouse, going to a child over 18, unless they're studying and therefore it's 25. There's tax implications. So you need to work with your lawyer, with your tax planner, with your wealth strategist to understand not only what to give, how much to give to people, but which assets to give to people. So you might give more of one type of asset to somebody and less of another, but overall it evens out. And that's to even out the tax planning.
I think this is really important. Most people wouldn't even think of that or understand what they can do with their superannuation, which, by the way, isn't covered by your will, is it?
Correct. That's a non-estate asset, and you've got to do different paperwork for that. Maybe I'll touch on that a little bit later on. So we've got to be cognizant of all those things, and you've got to consider, am I wanting to leave assets before I die or after I die? If you've got, say, property and you want to gift that to a child before you die, there's capital gains tax, there's stamp duty, there's an altering of the cost base. If it was a pre-capital gains tax asset, you lose that. So trusts can be quite useful and helpful. So setting up a trust before you pass away, and trusts don't work for everybody. That's why you need to have that conversation with your wealth strategist to see whether it's appropriate for you and how to use it to the maximum advantage. So if you do build up assets and in a trust, and you set up a trust that has got a lot of flexibility, we tend to call that a discretionary trust, then you can actually change control of that trust before you pass away without triggering taxes, without triggering stamp duty.
So in essence, really the owner of the assets, the property, doesn't change. It's the trust. It's just the people who control it, who have access to it, that change.
And therefore the benefits.
Yes.
So the legal owner doesn't change, but you effectively can decide who gets it. And there's different ways to do that to ensure that when you pass away, that those assets are not part of, can I call it a family dispute if there's a divorce.
So you're being kind, but if I could quickly explain that a trust is really a document, lots of words, lots of clauses, and I know that your team at Metropole Wealth Advisory include a number of special clauses. One of them is keep assets in the bloodline. So the average trust I've known, I've seen, we've worked with clients, don't include that. So I think there are some special things that your trust, our trust at Metropole Wealth Advisory include. And so therefore, yes, keep it in the family because, look, I don't know what the statistics are now, but it is close to 50% of marriages break up. You don't want it to go to the outlaws if you can stop it.
Correct. And just picking up on that point, Michael, the trust that you get off the shelf or the bulk you would get off your accountant or lawyer, they've got an inbuilt hand grenade. They blow up after 80 years, not literally, but they stop. So that means that would trigger a capital gains tax liability. And if that was a property and you wanted to keep that property, then that next person would have to pay stamp duty. So we've created at Metropole Wealth Advisory, we've designed and used trusts that have no end date, so that it's truly intergenerational.
Now, people will say 80 years. I don't have to worry about that. But interestingly, the first trust I set up in 2 years' time is going to be 50 years old. And so I may outlive it, but my children definitely won't. And their assets there I'd like to pass on to my grandkids. So, yes, it is something you should plan for long before you need it.
Correct. And who wouldn't want a property that was originally bought by great-great-grandparents 100 years ago? The dollar value of that rent, the capital value. So we don't want to destroy all that hard work just by it stops. So we've got to set up trusts, I think, keeping in mind asset protection, the estate planning needs, land tax. Have I got the correct clauses? Is it actually operated correctly year to year? Because you've got to do all those things.
Now, Ken, I'm really sorry to interrupt you, but I must say we always have a disclaimer at the end. This is not specific tax advice. You are an accountant. You've got financial planning qualifications. You've got a team of people underneath you with accounting, economic, financial planning degrees as well. But we can definitely, if somebody's interested in this, help you. We'll give you personal advice, but don't take any action based on anything Ken or I discussed today. And so I'm sorry to interrupt, Ken, but we really have to say that disclaimer because people are already thinking, I bet some are thinking, hey, I better do this, I better include that. And it's got to be done specifically for you. So if you're interested in this, sure, you can see your advisor, or Ken's actually an advisor to the average family accountant and to the estate planning lawyers. And so therefore, if you go to Metropole Wealth Advisory, I'll leave a link in the show notes, go to Metropole and click on the Wealth Advisory tab. We will give you specific advice, or we can if you want us to, but please don't take any action based on what we say at the moment. Sorry about that, Ken, but we should have said that early in the piece because we got to cover your professional indemnity insurance.
Thank you very much. Someone to protect my A.
Yes.
They're trusts that we set up before we die. And that helps us move assets pre-death if we have bought them in a discretionary trust. We actually call ours a family security trust because it invokes that speciality. Now, you can actually set up trusts after you die to put the assets in, and they're called testamentary trusts. So that your will needs to incorporate the terms and conditions you want that trust to be managed by, but it's not actually set up until you die. And it works very similar to a discretionary trust. And a lot of our clients set up that testamentary trust for one of four reasons. They want assets protected because the assets won't go to a person, they'll go to a trust. They want flexibility in distributing money to manage tax. They want to be able to corral and safeguard those assets against a family law court action, a divorce. And for more and more people who are sort of saying, maybe I'll skip the next generation and give it to the one after, i.e. the grandchildren or children under 18 who earn money that they haven't physically worked for, the tax rate is 66%. Now, I'll repeat that, 66%. On a sliding scale down to 45, and then plus Medicare, of course. So money given to a young child out of a testamentary trust is taxed at the adult tax rates. You know, the first 18,200 odd is tax-free, and then the incremental. So significant reasons. So you can't have a normal will that says when I die, I want the assets to be given to my children, because your executor can't say, oh, Ken should have done this. The executor has to the letter, follow your instructions. So you've got to do that prior.
So, in fact, a testamentary trust can be set up during your lifetime. It forms part of your will, but it only comes into effect upon your death. So I know that that's one of the things that your team help people with, if it's appropriate for them, setting up a testamentary trust. And all I can say is that my mother, I mean, you know, can set one up 30 years before she died. I was very lucky that she lived into her 90s, but it has made a big difference to how I can distribute assets to my grandchildren and help pay for their school fees, because I can do it in a very, very tax-effective way.
Correct, and it's protected, it's robust. Now, we certainly see a lot of clients who maybe don't have family around them for various reasons, and or they want to give part of their wealth to charities. So we're seeing more and more people set up either gifts to charities. And if you do want to make a gift to a charity, talk to that charity first to get their tax designation and also the Australian company number, the ACN. Because, you know, I had one client many years ago who wanted to leave money to Blind Dog Society. But which one? The New South Wales branch, the Queensland branch, and then it became, you know, a bit of a tussle. So you've got to be very specific. Other people want to set up what we call a charitable foundation. So can I call it the gift that keeps on giving? I had a client maybe about a year ago, no family, no immediate family, and we set up a charitable trust to actually fund a scholarship at the university she got her engineering degree. So every year her name would be called out, and there was a lucky recipient, and there was a rules and attachments, it was given to a female as opposed to anybody. So you can be quite specific, and you can also set them up that if you pre-death donate to that charitable foundation or your friends donate, they can even get a tax deduction if it's set up that way. So charitable trusts are quite important, and I think we're seeing that more and more as time goes by.
Well, I know a number of clients that we share who have done that, and what it basically does is it gives them a sense of purpose. It gives them a sense of why I've built all this, why I've done this, and it makes you feel good. You're helping other people, but there's also, you get some personal benefit from it as well.
Correct. It's everlasting as well. And I think for some people, they like the idea that there is a lasting component to their existence here on Earth.
Yeah.
But I think with all that, what's really the big crux that is, if you like, the aha moment that our clients get when they speak to us is the need to financially educate your family. How do you transfer? What do you use it for? Are there any negatives? Are there any positives? So teaching that financial responsibility is critical. I remember quite some time ago, my eldest son, Trevor, I said, come and watch me do my tax returns. And it was, why, blah, blah, blah. I'm a 17-year-old. There's better things to do in life. And it was, well, I'll give you some funds when I start teaching you. And he thought, oh, okay. And the next year he said, is it tax time yet? And then the other 3 kids want to be involved. But that's allowed me to actually show my children what they're going to inherit before they do. And therefore they've got that respect for it. And I'm actually engaging with them in how to manage those assets. So I'm the chairman of the board now, but I'll be that in spirit because of the education I gave them.
So I guess, Ken, it's not what you leave your children, it's what you leave in your children.
Correct. That is most critical. And look, sometimes we've got family members who are off the beaten track. They're the black sheep of the family by their own reasons or otherwise. Women could get married. They get beaten up. Obviously, that happens on the other side of the gender as well, but more so with females with domestic violence, the increase in drug usage, all those reasons. So you want to be very careful how you leave assets. You don't want to leave out a child, but one of the ways I've set up my testamentary trust with my kids is if one does become the black sheep, so to speak, then they lose any decision-making capacity that I would have left them. And the other 3 take over and then dish it out in the best way to advantage that 4th child.
So you're still looking after them even though you're no longer there.
Correct. And that takes me to another type of trust that we can leave for our children. Can I call that a special disability trust? So if we've got children with severe disabilities, where, who's going to look after them when the parents pass away? And you want to do it in such a way that the sharks of this world, can't easily attack and take money away from them. So for a lot of people, that type of trust, a special disability trust, can work because there's even tax advantages over and above anything else. Particularly if they're on Centrelink, there's different asset and income tests. Other people can contribute into that special disability trust with some tax concessions. So we've got to be very cognizant of those sorts of things as well, and then set those types of trusts up accordingly.
Any other tips, Ken, about some strategies we can help to pass on not just the wealth, but the education to our kids?
It deserves mentioning now, but we'll have to just touch the tip of the iceberg, is if you're in a business. So how do you leave your business to the next generation? Do they want it? Do you have partners in that business? And do your partners want your spouse or your children to be their business partner?
Yes.
So you've got to go through that. You've got to have, can I say, shareholder agreements. You've got to have key man insurance, buyout clauses. All those sorts of things need to be taken into account, and how something is going to be paid for. Are you going to buy out somebody using what money? So I saw a situation not that long ago where they took out a life policy, and the deceased person died, obviously, and the life policy was used to buy out that person's interest. That was fully taxable, the way they set it up, at 47 cents, given there was a significant amount of money. Whereas had it been done differently, you would have got the same outcome, but without the tax liability. So that is critical. That succession planning, I think, if you've got a business, needs to be discussed. And you also need to discuss it with your business partner. And then the complexities around, do you have properties that are jointly owned that you might operate part of your business, how that's all going to work. So education is the big thing. Teach your children about investing, the value of assets, how you've built it up, so that they take that legacy and carry it on for the next generation.
Now, I've heard that you've also set up education trusts, Ken. Where do they come into play?
That's an interesting comment, an interesting concept, I should say. And
I always come up with interesting comments, Ken, but they're not always interesting concepts.
We got 2 ticks there. So it's, how can I put some money aside that is tax effective that would actually help pay for my kids' education? And that can be set up pre-death, post-death. And, pre-death, even in a divorce, you can set up trusts that are taxed slightly different if it's funds that are going to be used for the minor child's upbringing and schooling. So as you can see, there's a number of different professional inputs into all this. Your accountant, your lawyer, your estate planner, your strategists. So we find that sometimes things can get overwhelming and complex, and we find a lot of our clients like the idea of having it all under the one umbrella. That way, everyone's speaking the same language. Each piece of the jigsaw puzzle is fitting in together, and there's no message lost in translation between one profession and another.
Well, that's really what Metropole Wealth Advisory specialises in. So let's have a shameless plug. How can you help our listeners, Ken?
Yep. So we take a holistic approach to our clients' circumstances, where we delve into, we start off, where are you now? Where are you trying to get to? What are the issues? What are the big ticket items? And during that process, we've got a framework where we map it out that allows us to look at tax, structures, estate planning, asset protection. We see clients all the time who all of a sudden are put into a managerial position. They've bought the home, they could have bought an investment property, some shares, and now they're in charge of the production facility. And they've taken on all that occupational health and safety responsibility. And, the responsibilities for that are getting tighter and tighter, where it actually goes back to that frontline manager, not the owner of the business. So you find yourself after 20 years having built up some assets, being promoted, and now all your assets are at risk. So how do I protect those assets in a way without triggering all the normal taxes? So people come to us for that. And then it's the hand-holding to implement, because that's normally where it falls down. It's you don't execute, you don't implement correctly. And that's why for us, it's the whole journey is part of the process.
Now, of course, while you are an accountant and your team are qualified in those areas as well, that's not what we're wanting to do. So we're not suggesting you leave your consultants, but sometimes you need a different level of experience. Does the typical accountant get a bit offended when you get involved, Ken?
Look, not so much anymore, because they realise that we're not poaching, if you like, a client of those. Yeah. So in a medical sense, we become the specialist and they're the GP, and we then work with the accountant in this example. It could be the lawyer or whatever, where we say, look, we've identified this, and we help them implement that. And what I found is that the typical accountant, it's head down, butt up, doing tax returns and compliance to meet the ATO's requirements. Their job is not to be strategically focused. So that's where we found there was a gap in experience and knowledge of how do you match strategy with operational. And yes, you can go to the big four, the big eight, and we all know what they cost. So our process and systems and procedures allow us to have that outcomes of the top end firms at the normal everyday Australian, if you like, price.
Fantastic. So if you're interested in finding more, and it's never too early to look at these strategies, inheritance and estate planning, go to metropole.com.au, and when you leave your details there, just say you're interested in wealth advisory and Ken will have a chat with you. So I guess estate planning does involve planning to start with, but then also you've really got to have regular reviews because your circumstances may change, your assets may change, the laws, the rules may change. The other thing I got from our chat today, Ken, is there's a range of inheritance strategies. It's not as simple as a will or a trust. So you need somebody with a broad-based knowledge to help you. Thanks for your time, Ken. Look forward to catching up again I catch up with you very regularly, but on this podcast real soon.
Thank you, Michael. Thank you, audience.
Now here's Michael's mindset message. Remember, a change in your thinking will lead to a change in your life.
In my mindset message today, I'd like to ask you a question. Whose investment are you? The fact is, most people work for someone or an organisation. From the perspective of the employer, their employees represent an investment, an asset. From the perspective of an employee, their employer is a means to an end. And that end, for most unfortunately, is just that payday, the paycheck. However, a select few, they're in it for more than a paycheck. They go the extra mile. They do more than their job description. They pursue responsibilities that go beyond their job description. And here's a little known secret to success that only a small number of employees have ever discovered. Going that extra mile is an investment in themselves. You know, when you do more than your job requires, you grow. As you grow, you become more valuable, not just to your employer, but to every competitor in your industry. The more you go beyond just earning a paycheck, the more you learn, the more new people you come in contact with, the more the value of your own stock rises. Going beyond a paycheck and your job description shifts the investment from your employer to you. It's an investment in yourself. And the more you invest in yourself, the more opportunities you create. And that's one of the hallmarks of self-made millionaires. If you want to become successful in life, you must invest in yourself. You've heard the late Jim Rohn say it so often, work harder on yourself than you do on your job. You must take the responsibility that pushes you outside your comfort zone. This discomfort, it means you're growing. So when you go above and beyond your job description, you're no longer an investment of your employer, you become your own investment. Well, thanks for spending the last little while with me, and I hope you got some benefit from this show. If you did, and you know somebody else who'd also benefit, please tell them about the Michael Yardney podcast. There's a share button on every podcast app. On Apple Podcasts, there's 3 little buttons down the bottom. Press it and share it, or just tell them about the Michael Yardney podcast. I hope you're going to be doing them a favour, and you'll definitely be doing me a favour and helping me in my quest to make as many people as possible financially literate. Now, there's ways of catching up with me between these shows. Just look for Michael Yardney on social media, or why not join my private Facebook group? Go to Facebook and look for the Property Update Facebook group. And I have a way of saying thank you to you for subscribing to this podcast. Go to podcastbonus.com.au. There'll be a link in the show notes, podcastbonus.com.au, where you can get a bunch of ebooks and reports. My way of saying thank you. And when you've got time, why not listen to some of the old podcasts? There's individual lessons in each of those that I think would be helpful for you. I'll be back again real soon. In the meantime, have a great week. Make it a great week.
Thanks for listening to this episode of the Michael Yardney podcast, which was brought to you by Metropole, who help their clients grow, protect, and pass on their wealth through strategic property and wealth advice. If you like what you heard and don't already subscribe, you'll find us on iTunes or on your favourite Android app as the Michael Yardney podcast. Watch out for our next show, which comes to you twice a week, and you'll learn some new ideas about property investment, success, and money in around 30 minutes. To get more of Michael's thoughts, go across to www.propertyupdate.com.au and sign up for his daily morning briefing, and you'll hear from not only Michael but a group of leading property success and money experts. And just a reminder that the information you heard in this show today is general educational advice and not specific investment advice, as we don't know your personal circumstances. If you're looking for specific advice, why not ask the team at Metropole to help you?